So you might have been following the story with Hargreaves Lansdown over the past few months, as this business has been going through quite a lot of pain recently. Now, over the last 5 years, Hargreaves Lansdown's share price has tumbled almost 40%. And just for a bit of context, the global stock market has returned more than 60% in that same time frame. Now, not only are investors not happy with the company, but the founders of the company, who still own a large number of the shares, have also voiced their concerns over the way the company's been managed since they let go of the reins. And the latest news that you may have seen is that the company have agreed on a takeover bid that will get put to shareholders very soon. Now, this has been going on for a while, and there have been a few bids that have been rejected, but now they seem to have settled on an amount that works for both parties. The offer that was submitted is for a total of £5.4 billion, and this is pretty much what the company is worth right now at the moment on the stock market. Its shares have actually rallied more than 60% over the past 6 months as the takeover bid rumours have spread, so at least some shareholders in the short term must be very happy. Now, many of you would have been aware of the company in the investing world, as Hargreaves Lansdown is the UK's biggest investing platform, and they've had a great reputation for a very long time amongst their very loyal customer base. For some perspective, they manage around £150 billion worth of customer assets, and they have 1.8 million customers here in the UK. They've got all kinds of accounts, whether it's a stocks and shares ISA, pensions, cash ISAs, junior ISAs, and general investing accounts. It's worth saying that on average, the users on the HL platform do tend to stick around for a very long time, and they have a very large number of clients with multiple six-figure and multi-million pound portfolios. So what about the details and what happens next? Well, this offer is being led by a well-known private equity firm called CVC Partners, with a few others along for the deal. Now, this company is one that's been around for a very long time, and they've made some very big deals in the past that some of you might be well aware of. They've had a history buying stakes in La Liga, that's Spain's football league. They've had a stake in Formula One for more than a decade, and they made a profit of $7 billion on that one. And loads of other investments like Sky Bet, Debenhams, which didn't go so well, and even the maker of PG Tip. So these guys are everywhere, and now this begs the question, what is next for the company, and why do they think it's a good investment? After all, they wouldn't be buying Hargreaves Lansdown if they didn't think it was a good deal, or that they could make a profit from somewhere later on down the line. So firstly, it's worth saying that this deal would take Hargreaves Lansdown off the stock market and into private hands. So that would be a big loss for the UK stock market, which keeps getting hit with things like this. Now, private equity like this has taken quite a few companies off the public market. I can think of a good example off the top of my head right now. Darktrace, the cybersecurity company, was taken private not so long ago. Presumably, they think they can grow the company and make it better before making a profit. So on that note, let me just quickly look at the financials to see how much Hargreaves Lansdown actually make, as they are well known for being quite an expensive investing platform for retail investors. If I take a quick look at their revenue numbers over the long run, you can see that they've increased from £358 million in 2014 to now £753 million from the latest figures. However, you should also note that their costs have been growing quite fast as well. So with that doubling of their revenue, they've not doubled their profits as you might expect, because they've also doubled their operating expenses. If you have a quick look here, you can see that the business has grown its costs massively since the global financial crisis, and it's been especially high since 2017, when it looked like it was actually coming back down. One thing also worth noting here is that the company is very profitable. As you can see here, the gross margin sits at 100%, as there's no cost of products, and this leaves them with a very healthy net margin of 44% from the current year. Now, it has been recently heading in the wrong direction. This explains some of the action in the share price. You can see here that in 2013 and 2017, the company was making a lot more profit, both in net margin terms and in free cash flow. Remember that free cash flow is what you end up with once you take your operating income and then you remove capital expenditures. So if you have a low free cash flow but high operating income, then it's because you're spending a lot of money on big one-off costs, which could be a whole number of things. This new offer and proposed deal would likely take the company and try to turn things around, but it would be very hard to say what happens next if you were a customer. I was looking at some of the comments on the Financial Times website to the article about the bid, and there was a lot of concern around the takeover, as people were assuming that, as any kind of private equity company does, it's just going to try and bleed the company dry or even try to put fees up. Now, this would obviously be a huge concern for many people, as the fees for the platform are already notoriously high, and I was a customer for a number of years here too, before I even realised what kinds of fees I was paying. I suspect many customers who have been at the company for a long time couldn't really tell you what their investments are costing them. and wouldn't really be able to explain exactly what the fees are. I remember doing a video on this topic quite a long time ago, and it still gets quite a few views to this day. Feel free to go back and watch that one if you want, if you're a customer at the moment. So in terms of what this means for shareholders, I understand that you're going to get the option to either get paid for your shares or have your investment roll into the private equity fund. So essentially, if you were to do this, and you'd still have a stake in the company, but you wouldn't be able to sell it on any public markets. You might not be able to do anything with it at all until the company gets sold, which could be many years away. Now, time will tell what CVC and the other investors intend to do with the company, but the bottom line is that ultimately they are going to want to increase those profits somehow and grow the business. I'm not sure that they'll be able to attract a huge amount of new money into the platform, in my view, as the space is super competitive now. There's so many platforms to choose from, and there's a lot more user-friendly and much cheaper ones out there. Now, as many of my regular viewers will know, keeping your fees low is probably one of the most important things that you can do as an investor, and it's one of the only things that are actually in your control. I'd definitely be interested to know what your thoughts are. Now, let me know in the comment section on this one, especially if A, you're a shareholder, and even better, B, if you're a shareholder and a customer on the platform as well. Now, this leads me on to the final point. With everything going on, what options does this leave you as a customer on the platform? Now, I know many of you out there will have accounts here and possibly quite a lot invested in different funds and shares. So first off, it's worth saying that everything would be business as usual from an investment standpoint. It's not like it's closing down or anything. You still are an investor, and what's yours will remain yours. However, I think that what is less clear will be any changes in the future to fees and charges. As I mentioned earlier, this is already a very expensive platform to use, and although there are some hacks to make it cheaper and some great features, most people can do better, at least in my opinion. I think generally a lot of these legacy investing platforms rely on very loyal customers over the very long term to pay them large amounts in fees without them really getting anything special in return. Now, you can definitely argue that Hargreaves Lansdown are a trusted name and that should come at a price, but I do think there's so many options out there that I can't see the argument being made too much based on that one. As I mentioned earlier in the video, I used to be a customer a while back, but I have since moved away both my pension and my ISA accounts. Ultimately, for me, the fees and the old-fashioned feel of the platform drove me away, and unless they start investing in their own infrastructure and make things cheaper to attract new customers, I think they might continue to struggle a bit. If you want my view, I personally think that any service in life, you shouldn't be blindly loyal unless that loyalty pays you in some way. I think way too many people end up paying so much by sticking around. Just think about things like broadband contracts, TV deals, car insurance, and all of the rest of the contracts that most people have. Anytime you don't shop around and just roll things over, you end up paying more, and you might wrongly assume that it's either a hassle or just not worth the time to switch or make a change. In my view, we need to get away from that way of thinking. And in financial services, it's actually very easy to move money around and make it work for you on a platform that might better suit you. Obviously, I'm not a financial advisor or anything like that. Make sure you do what suits you, but that is just my opinion. Now, on other platforms and things I use myself, I do leave that link in the description below, so do check that out. And there's also a link there to get hold of my best stocks and shares ISA spreadsheet for this year if you are interested in comparing different platforms. Now, a question back to you then. I'd love to know what you think about this and whether or not you'll be staying as a customer, and if you're a shareholder, will you be taking your cash and running for the hills or hanging around to see what happens? I'll maybe do an update video on this topic if there's enough interest, so do keep your eyes peeled for that one. And until next time, happy investing.